Hello and welcome back to Bunnex Investment Group. If you're new, consider subscribing to this channel so that you won't miss any of our valuable content. In this video, we are going to be talking about the ID50 strategy, which is basically the easiest BTMM strategy available. Anyone can trade it as long as you can follow some rules. But before we talk about it, we have a free Telegram channel where we share free signals. I'll leave the link in the description box below and be part of that community. All right, without further ado, let's jump into the content. What is an ID50? And some would love to call it a 50-50 trade bounce. Basically, I love to call it an ID50 so that it won't be something that is confusing. So whenever we get a reversal point, we call that reversal point a peak formation high or a peak formation low. A peak formation high or a peak formation low is a point whereby we see a reversal of the market. So the first step whenever we are trading the 50-50 bounce or the ID50 is to basically see a valid peak formation high or a valid peak formation low. So to simplify the whole strategy, we are not going to be talking about in-cycle peaks, which we call resets, but we are going to talk about third level peaks. What is a third level peak? A third level peak is a turning point of the market after 3 levels or after 5 levels. We basically say it's a reversal point after 5 days of rise or after 3 days of rise or drop. So like in this scenario, you can see that there is first day of rise, second day of rise, and third day of rise. Therefore, this is a valid peak. So peak identification or peak validation is the first step whenever we are trading an ID50. After that, we now need to see crossover of exponential moving averages. For the sake of those who are new to this channel, these exponential moving averages are easy to input because all of them are all inbuilt or default indicators on all tradable or trading platforms. The one in red is a 13 EMA. The one in yellow is a 5 EMA. The one in blue is a 50 EMA. In white is a 200 EMA. In dark blue is an 800 EMA. And this is called the Traders Dynamic Index. It's basically for confirming when we are trading M's and W's, which will help us to get what we call divergence on the markets. So like in this particular case, we can see that from this lowest point, we had the market, we saw the market going to the upside like that. But whilst the market was going to the upside, we had these things that we had taking place. We can see that there was a first day of rise here, but this first day of rise actually came after we had the first drop, right? One, second day, then third day. We've said a peak formation low will need at least 3 days of drop for it to be valid. This was a peak formation low which had a first leg, then neckline, second leg, and after that we had the first rise. After that first rise, we can see that there was a push and a pullback to the 50, which is the one in blue. If we get something like that, we want to make an entry after this H1 closes above the 50 EMA. So in this case, there was this red candle that went to the downside, this green candle, but unfortunately it did not close above, but this one closed above. So we can hold that particular trade for 2 more levels. So we entered after retest of the 50 EMA and then close above the 50 EMA. That was the case, or on the H1 time frame. After that, we can see that there was this particular drop and we call this a reset. It's unfortunate that we are not going to be talking about mid-range peak formation lows or peak formation highs. Therefore, this was not going to be something that we use. So from there we can see that we had first rise, right? Validating a peak, we need 3 levels, at least 3 levels for us to get a valid peak formation high. And in this case, a valid peak formation high was issued as an M pattern, first leg, second leg. And then after that, we can see that there was this crossover of the 13 and the 50 EMA, meaning that our entry required us to see a retest of this particular 50 EMA and a candle closure below the 50 EMA, meaning our sell was going to be at this particular point. We've said we can hold that for 2 days. Day 1, day 2, we exit. But unfortunately, what we would want to see is basically a crossover of the 1350 after at least 3 days or 5 days. We can see that there was 1, 2, 3, 4, 5 days of drop. So it means this particular point was going to hold as a valid peak, right? If this was a valid peak, it means we wanted to see a 1350 EMA crossover, and after that 1350 EMA crossover, we wanted to see a retest of the 50 and a candle closure above the 50, which is what happened. So this is where we're going to make our buy after this candle closure above the 50, and then hold it for 2 more days to reach a peak formation high. So basically that is how we trade the ID50. Nothing much and nothing special about the setup. All that we need is to validate a peak first, and then after validation of a peak, we need to enter and hold for at least 2 more days before we exit that particular trade. On that note, we've come to the end of our today's video. Thank you for watching. Like and subscribe, and I'll see you in the next one.